Good morning, everyone. My name is Craig Witmer. Just as a brief bio, I've been with the firm here for about 25 years and really spent the entire amount of my career focusing on governmental clients, work with a few other types of clients, but I help to head up the local government services niche here for our firm.
My name's Teena Curnow. I joined SEK in 2004, right out of school. I've been here for just over 20 plus years. I currently work only with our government clients. So I fill my year with all government audits and work between all of our available government areas with municipal authorities, school districts, municipalities. So I work very closely with Craig and everyone else on presenting today. So the first presentation, as Christina said, we're technically doing two presentations here, but Craig and I are, for the most part, tag teaming them. So we've kind of put them back to back. So the first one we're looking at here is just a general GASB standards update. So GASB, the Government Accounting Standards Board, that's the board that basically creates these standards that you then need to follow depending on your reporting. So for the most part, if you are reporting on a more so full accrual basis where you're recording the capital assets, you're recording the debt, if you have any kind of regulatory requirements, a lot of times these standards fall into that with how you need to record things, timelines, deadlines, things like that. So that's what we're going to focus on here. We're going to focus on those that are required to follow these standards and actually will have impact with these recent implementation that will need to happen for standards that have been issued. So each year we do this presentation, we try to only include the most recent standards that have been finalized or implemented, because as you can see with the numbers here, they're at 103. So today's presentation is really focusing in on the four that are on your screen here that are either will be implemented in this current period or in the near future. So the first one that I'm going to talk about here is GASB Statement 100. So this is the statement that just refreshes, if you will, because there's already kind of a standard that explained the process of how you need to go about this. But this is a revision essentially of previous guidance regarding how to account for changes or errors that are identified. So this standard is effective for periods beginning after June 15, 23. So that means calendar year 24, fiscal year June 30, 24. And the goal obviously is to provide better reporting over these changes and error corrections. So there's different types on the next slide. There's different types of transactions or events that fall into this standard. You have a change in accounting principle and a change in an estimate, change to or within the financial reporting entity, and then obviously a correction of an error. So the first one there, change in accounting principle, how you account for that would be retroactive, meaning you go back and restate any previous periods that are included in the financial reporting. So if you have single year reporting, you would restate that beginning equity. If you have multi-year reporting, then you would go back to the earliest period being presented on your financial statements and update them for what it would have been if that standard was in place for that whole time period. And so an example of these are recently GASB 87 with leases and 96 with the subscription-based IT arrangements. They would be considered a change in accounting principle because you're implementing a new standard. So for any of you in the seminar here that had to implement those standards and actually had an impact for that, you likely seen a restatement footnote in your financial statements and some explanation on that. A change in estimate, you look going forward. That would be something, for example, if you decided to change the useful life of assets, or if you wanted to change how you're estimating an allowance for doubtful accounts, for example, that you would change as of the point in time you decide to make that change in estimate and going forward. The third one there, mostly here, is where you're seeing if you have a transfer of operations, things like that, an internal change, or something to the effect of component units. Some on the call may not need to deal with that, but a lot of governments have component units, or they are a component unit, and changes within that could also fall into this. The last one, correction of an error, it's exactly how it sounds. You found out in a later period that something was wrong. It was either not included or was included at the wrong amount. You want to correct that. That is a retroactive change where you go back and change the earliest period that's being presented to account for what it would have been if that error hadn't been made, or omission, or whatever the case was that was found after that period. For this standard, there are a couple different situations where you would change required supplementary information, that RSI, SI supplementary information, and the MD&A, the management discussion and analysis. So if you have a change in accounting principle or changes within the entity, there you do not need to restate. If there is an inconsistency because of how you're presenting the information, you are supposed to include an explanation of the change, but you don't need to actually physically go and change all of those prior numbers in those particular pieces of the financial statements. If you have an error correction, you would just change to what the number is supposed to be.
All right, thank you, Teena. So the next standard we're going to review here is GASB 101 for compensated absences. And for those of you not familiar with this, it is kind of what it sounds like, different types of PTO, vacation leave, sick leave, things like that, that you would have within your organization and potentially cause you a liability in the future. So this standard, on the surface, when you read the standard, if you currently record a compensated absence liability, you may think, well, there's not really a whole lot of changes here. They have kind of fine-tuned and eliminated some of the options previously with compensated absences. But there are some nuance to this that I really feel that most entities that record a compensated absence liability are likely going to see some changes as a result of this standard. Next slide, please. So when does GASB 101 for compensated absences, when does it require that you actually record this liability? Well, it's situations where you have this type of leave and the leave has not been used as of the end of the year, or the leave has been used, but it hasn't yet been paid in cash or settled through some sort of non-cash means. So, and then to further dig into that, the liability, you recognize that if all the following situations are true, the leave is attributable to services already provided. So essentially the employees have already worked and they've already earned that leave. The leave accumulates, or i.e. can be carried over from one year to the next, where you're going to have the potential of that leave being utilized or paid out in the future. And then the final attribute there, the leave is more than likely than not, or greater than 50% is what you're looking at there, to be used for time off or otherwise paid in cash or settled through non-cash means. So it's more than likely that it's going to be utilized at some point in the future. And then just down there in parentheses, when you actually do have this liability and you record the liability, you are looking at the pay rates that are in effect as of the end of the fiscal year. Now, obviously that leave, that liability, that's going to be utilized in the future or paid out in the future, but you're not projecting into the future to try to guesstimate what pay rates are going to be then. You're really just looking at your pay rate at the end of the year And the other piece of it too, any salary type related payments that would go along with that, you're considering that as well. So how do you assess that more than likely than not, or that greater than 50%? How do you determine what that is? What is a little bit nebulous, but you can take a look at some things within your own policies to maybe give you some guidance as to, it's likely that that's going to be used. Has it been earned? Is it actually going to become eligible in the future? And really taking a look at your own history and seeing trends that you have within your own organization. And this is an important aspect to think about with the standard. This is not a one size fits all type of standard for every organization. Every organization's compensated absence policies are different, and your own historical information is going to be different. So you really have to have a grasp on that as you are working through these calculations. And you may look at that past history and determine maybe there's something different moving forward, a deviation from that past historical information, where you can use that as a guide, but maybe you need to form your estimates a little bit differently moving forward. So this leave, it does not include any kind of leave that is converted to pension benefits. Maybe that's a situation where you have unused leave, individual retires, and that gets converted to pension benefits. That would be calculated under the pension standards and not this particular standard. It also does not include leave that's dependent on a sporadic event. Parental leave, military leave, jury duty, those types of things are often baked into compensated absence policies. Those types of leave, you're only going to record that as an expense or a liability once the leave commences. So you're not trying to look forward into the future for those events. It also does not include holiday leave or unlimited leave. Unlimited leave is something that is becoming a little bit more frequent that we see that. This standard does not try to calculate any kind of liability associated with unlimited leave. So what's different here in terms of calculating this liability? And if you think about it, it may seem somewhat simple. You have vacation or sick leave, PTO, certain amount has been earned as of the end of the year. Here's their pay rate. Here's the calculation for all those employees. But this is where the nuance kind of comes in. And I think when you first look at the standard, you might brush over this a little bit. But here's where we're going to see some changes with this new standard. So, and it's really kind of focused on sick leave, because in the past with sick leave, what you actually recorded as a liability was a projection into the future of what was going to be paid out from sick leave when the individual retired or was terminated, depending on your policy. And that's what was actually calculated as a liability, and you calculate a probability that individual would stick around until they retired and actually receive that payment. So that's now changed. Essentially, you're going to take a look at all of the sick leave liability or any type of leave and consider whether they're going to use it or be paid out. And it's that use it piece that is new that likely wasn't recorded as a liability in the past, specifically with sick leave. Where that becomes a little more complex here and is going to take some effort is especially if the sick leave is paid at different rates. So, and we do see that a lot, where obviously if the employee utilizes the sick leave in the future, well, that's going to be paid essentially at their full rate, which you are calculating as of the rate at the end of the year. But many times in policies, what we see is when the individual retires or leaves and they're actually paid cash for their unused sick leave, many times that's at a different rate. It might be 50% of their pay rate, or maybe it's limited based on the number of days, different types of things. And again, that's all contingent on your own policy. So when you have that situation, here's where estimates, come into play. You essentially have to allocate and calculate and estimate how much of that leave is going to be utilized as sick leave. And then you're calculating that at the full rate versus how much of that is going to be paid out in cash when the individual leaves in the future at that different rate. So that hasn't been done in the past. That is really a significant change here. And again, something that you're going to need to take a look at your own history and come up with your own estimates. There isn't one size fits all. Your auditors won't be able to come in and say, well, use 25% for this and 75% for that, or any kind of specific allocation. Really got to take a look at your own situation and estimate what you believe is going to occur there in the future. So we're going to take a look at a couple examples here, and these are pretty basic, but just to give you a flavor for this, for when you would record a liability, when you would not record a liability. So on the next slide with scenario A, this scenario is, say you have PTO, paid time off, it's earned each month, and it can be carried over without limits at the end of the fiscal year. And if there's any unused leave, that's going to be paid out at termination of employment. So, do you have a liability to record here? The short answer is of course, yes. When you look at the three key elements, well, the leave is attributable to past services. They've earned that leave. The leave accumulates. Obviously, it's carrying over. It can be used in the future. It's going to be paid out when they leave. And as I said, that unused leave, it will be paid out. So there's not going to be any losing of the leave that has been earned. So in that situation, you're going to record a liability for the compensated absences based on that entire PTO amount. And if they're paid at the same rate when they leave, you're really just looking at that as one pool altogether to do that calculation. In the next scenario, here we have, sick leave is earned each month, carries over without limits. However, that unused piece of the sick leave, that is not going to be paid at termination. So the answer to this one, a little bit different. You still have those elements for the most part where it's been earned, it carries over, it can be utilized in the future. However, what's different here is the fact that it's not being paid at the end when the individual leaves. So in that situation, there's that, where the estimates come in and you need to determine how much of this leave is going to be utilized as sick leave, and that would necessitate the recording of a liability versus what's not going to be used and essentially lost when the individual leaves the organization, and you would not have a liability recorded for that. And then the final scenario, here you have sick leave is earned each month, but it doesn't carry over at the end of the fiscal year, and it is not paid out at termination of employment. And in that situation, probably pretty obvious, but there's no liability here at all to record. You have part of the elements that the sick leave is earned each month as the employee works, but there's no carryover of it. So there's no ability for them to either use it in the future or get paid out. So there is no liability to record in that situation. So with that, we have a poll question here if you want to be sure to answer that. And I will turn this over to Teena to talk about GASB 102.
So GASB 102 is for certain risk disclosures. This is effective for fiscal years beginning after June 15th, 24. So that means 2025 for reporting as far as needing to account for this. The objective, like with most statements, is just to help provide a little bit more information, clarity, details in the financial statements that aren't, in this particular case, aren't really in there for the most part right now, or not likely. So the requirements of this is the entity would disclose information about risks that relate to what they consider vulnerabilities for concentrations and constraints. It defines what a concentration and a constraint is and gives some examples of those. What we will likely see with most of our entities, our clients, the governments, concentrations similar to what you would already have now. If you have a large customer or you utilize one or two large vendors for most of your purchases, they would be more concentrations. Constraints are things like debt limits, tax limits, things like that, where you have a constraint of how much you can raise taxes or how much debt you can take out. So those are kind of the most applicable examples we're kind of expecting our clients to be affected by in these particular situations. But from a disclosure standpoint, next slide, what you're going to be needing to think about essentially to disclose is the requirement will be there if you have all of the criteria. There is an actual concentration or constraint that's known to the entity or to the government prior to issuing the financial statements. That concentration or constraint makes the government vulnerable if an event would happen that would lead to substantial impact to the entity. And here is the what we call kind of crystal ball piece of this standard. An event that could impact this concentration or constraint has occurred, will begin to occur, or is more likely than not to occur within the next 12 months after the date of the financial statement. So not the fiscal year end, but the date of when the financial statements are issued. So you need to look forward. You need to first identify these concentrations and constraints and look forward to whatever may happen that would ultimately require some kind of disclosure in the financial statements. So this is going to be judgment. It's similar to what Craig said with the compensated absence portions of that standard that need implemented. It's going to be very difficult for your auditor to give you much guidance or support in this area in regards to that particular piece of it. So that's something that, again, not applicable right now, but in near future will be that all of you, not all of you on the call, but if you would need to implement the standard, would apply to you. So what you would need to disclose on the next slide shows you need to disclose the concentration or constraint, basically explain what it is, and explain each event that could cause that concentration or constraint to have substantial impact on the entity, and then any actions that may have been taken by the government before the issuance of the financial statements to mitigate that risk. So that will be essentially it for your auditor. Make sure you have discussions with them as you near implementing this standard to make sure that you have a little more information, a little more details about it. This is obviously just a couple minute summary of it, but you'll definitely want to get more information on that as it comes due for implementation.
All right, so our next standard here we're going to talk about, and the final standard we'll go over this morning, is GASB 103. And for those of you who have been around for a while, you may be familiar with GASB 34. This was issued in the late 1990s and implemented in the early aughts, the 2000s. And it was extremely significant, really kind of shaped the current reporting model that we have, totally changed governmental financial statements. So this standard it's not a redo of GASB 34. It's really a refresh, and it's something that GASB has been working on for quite a while. I can remember giving a presentation on this standard probably about 5 or 6 years ago. Maybe things were delayed a bit with COVID, but even though it's just a refresh, there are some significant elements of this, and different pieces of this. Not all pieces of this are going to impact every single governmental entity that hit the issues with GASB standards. But there are some big pieces of this, and it's likely going to hit most, if not all, governmental entities. So the first one here, for anybody who prepares external financial statements, the management's discussion analysis is probably near and dear to your heart. It is what it sounds like. It's prepared by management. We as auditors who may be assisting with your financials, we can't prepare that piece of it. So they are fine-tuning this with the management's discussion analysis. I think what GASB has realized after many years is in many cases this part of the financial statements has become kind of boilerplate, where numbers are updated from one year to the next, but really the goal of the management's discussion analysis is that analysis piece of it, where you explain the why of what happened during the fiscal year, a little bit of looking into the future. And in many cases, the MD&A just kind of touches on that why just a little bit, and not necessarily enough. So that's the emphasis of the changes in these requirements, not wholesale changes to really the elements that are supposed to be in there, but focusing on expanding on that explanation within the MD&A. Couple other nuances here with the standard. These are a little bit smaller as far in terms of impact. In the past, there was something called extraordinary items or special items, different circumstances when you recorded those, but they were kind of what they sound, just things that don't happen that often that require and should be shown separately within the financial statements to spell out the importance of those. They are now combined into one item called unusual or infrequent items. A little bit of definition change here in terms of non-operating revenues and the way that that is determined. Specifically, there's a definition for non-operating revenues, and everything else is going to be classified as operating revenues, hopefully to bring some more consistency to that. When you go from one entity to another, really can see some inconsistencies between what's operating versus non-operating. It's going to be a new section on proprietary fund income statements for non-capital subsidies. A lot of entities do receive those. They will be broken out separately now on that statement. If you have a statistical section, probably not many of you do, but if you're familiar at all with the annual comprehensive financial report, there are standards that lay out additional pieces that get included in that statement in addition to the regular financial statements. And one of those is the statistical section. And this now requires for essentially a matching for the proprietary fund or business type activities, whatever categories of revenues and expenses are displayed in the basic fund financials, the face of the financials, they now need to be mirrored and showed specifically the same way within the statistical schedules. Component units, if you're a larger governmental organization, you may have some component units that roll up into your financials. In that situation in the past, there was a little bit more option as to how you presented those component units. There was an option to include condensed information actually in the footnotes. That has been removed, or that option is no longer available. And they're now required to be shown individually or in a combining statement that's going to follow the fund financial statements. And then finally here, in terms of changes, and this is another one that is definitely significant in my mind, it now requires the budgetary comparisons. One, in the past, that could be shown as a basic statement at the front of the financials that now must be shown as RSI or required supplementary information. But there's changes to it. You have to add a new column that shows a variance between the original and the final budget, in addition to the column that shows the variance between the final budget and the actual results. And then most significantly is you now have to explain significant variances in the notes to the RSI. Essentially, this was a requirement of the MD&A in the past. It's now being removed from the MD&A and now needs to be shown separately as RSI. So really kind of bringing more attention to that. And I will also say, you know, we as auditors don't necessarily see us being able to do that as part of the process. So finally here, probably one of the bigger things is what's not included in GASB 103. If any of you were potentially following this standard over the years, one of the more significant aspects that was originally included was to change the basis of accounting for governmental funds. And that is currently the modified accrual basis of accounting. Not going to get into the nuances of that, but it is different than, it's not cash and it's not accrual, it's kind of in between. So this standard was going to significantly change that for governmental funds. And that would have required some pretty substantial effort to make that happen. Last fall, when the GASB was getting closer to the end of issuing this standard, they decided to pull that part out and essentially give us all a little bit of a break and for the time being, and not include that in the standard. Now, I will say, I would not be surprised if this comes back around in the future at some point. So, can you just back up there just for a second, Christina? Thank you. So I wanted to mention that within this standard, there are a lot of illustrations. Many standards that come out, they put out new requirements, new things for the footnotes. Unfortunately, they don't always give us illustrations, but there are a lot of good illustrations within this standard, and they have a full sample MD&A. So that's something that you can take a look at to say, well, what's a good example that my MD&A should look like? What's GASB looking for? Well, they've provided us with an entire sample of what that could be. These changes are going to be effective for year ends June 30, 2026 and later. So That may seem like a little bit away, but 2 years goes by relatively quickly. And then just a quick glance here into the future. I'm not going to go down through all these, but this slide just gives you a little bit of a flavor of what GASB has kind of on its docket right now that it's working on, and some projected time periods in terms of years when they expect documents to be issued, whether it's final standards or exposure drafts, et cetera. Some items I'll mention there, subsequent events, going concerns. I expect them to probably tweak the disclosures required associated with that. And then you can see down there in 2027 revenue and expense recognition. Possibly that's when we see something come back around in terms of that standard there for changing modified accrual accounting, but not sure at this point. So we'll pause there for a second for any Q&A on this part before we jump into our next section to talk briefly about single audits.